into the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710.
Can you hear me?
800-321-0710.
Stand by.
Now, let's kick off your
Others in the
financial
shadow.
future. Here's Josh Jalinski.
Good morning, everybody. This is Josh Jalinski, the Financial Quarterback. Give us a call, 800-321-0710. We're taking your calls on all matters financial, about the money and the markets right now. This is Josh Jalinski, the Financial Quarterback. If you have questions on stocks, bonds, annuities, mutual funds, no question you ask is a dumb one, except the one that you do not ask. So call us now, 800-321-0710. 25% of you are delaying retirement due to inflation, a survey finds, and your Social Security check might be taxed. Here's how that could change. And choosing between pre-tax and Roth 401k plans can be much trickier than you think. But first, I'd love to hear from you. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one, except the one that you do not ask. So call me right now. We're here taking your questions. It's a live show. So usually rollovers involving 401ks and IRAs involving moving dollars from a plan to an IRA. But sometimes it makes sense to do a reverse rollover. Maybe you didn't know that. Check with a knowledgeable financial advisor before finalizing a reverse rollover. That's when you move money from an IRA to a 401k. Americans' finances are being squeezed as inflation pushes up prices on things such as rent, groceries, and gasoline. As a result, 1/4 of Americans are delaying retirement due to inflation, according to a survey between March 30th and April 25th. Good news is that people are actively making changes to their budgets to combat rising prices. Putting off retirement plans is mostly due to disrupted savings from increased prices, the survey found. 36% of survey respondents have reduced their savings, and 21% are putting away less for retirement in order to keep up with growing costs. Maybe that's you. We haven't seen this level of inflation in a very long time, and it's daunting, said Paul Dilda of the BMO Harris Bank. He added that many people in or near retirement may not have considered the surge in prices in their financial plans, which has thrown off budgets and timelines as well. Younger Americans have been the mostly adversely affected. More than 60% of those aged 18 to 34 said they had to pull back savings contributions to make up for rising costs of necessities. So far this year, the S&P has shed more than 13%, a stark contrast from the previous gains of last year. It's difficult to save, and these times are making it even more difficult. This includes changing how people shop for groceries, what subscriptions they pay for each month, and even how they vacation for the time being, the survey found. Americans are also planning more than they were before inflation spiked. According to this report, this quarter, more Americans are setting yearly budgets, writing down a financial plan, to follow and meet with their financial advisors monthly. What are Americans doing right now to combat inflation? Now, number one, they're dining out less. I'm going to throw the question open for those of you in the room and also on our listening audience on WOR. You can call us at 800-321-0710. What are you doing to combat inflation? Most people are doing 5 things right now. They are dining out less. They are grocery shopping. They're driving less. Pay for, save on gas. Canceling or spending less on vacations. Cutting subscriptions. So the 5 biggest things that most people are doing to combat inflation are the following: dining out less, grocery shopping, driving less, canceling or spending less on vacations, cutting subscriptions. And I'm going to give you a couple financial tips. But first, we're going to go to the phone lines, and we have Dan. Go ahead.
Good morning, Josh. Nice talking to you. So I just read that they coming now with a Secure 2.0, and I just wonder if you can kind of put some light on it, especially as far as the RMD here, because they're changing it. Just to give you some background here, I will be turning 72 very soon, and I know they're changing the date, and I just trying to figure out how it would reflect on me as far as the RMD requirement. Thank you.
So the Secure Act, as we know it, changed the game on retirement planning. So if you have an IRA, a 401k, a 403b, a 457, listen up. We're going to go through what you can do. But first, realize that your IRA is essentially a tax ticking time bomb, because you're choosing to defer to a future point in history when you don't control the tax rates and you don't control the tax laws. Can somebody turn Dan down? I hear feedback in my ear. So essentially, the Secure Act changed the game as we know it on taxation of your IRAs. So it raised the RMD to 72. Now, there's been talk of raising the RMD to 75, not 72, but for right now, it's 72. The negative of the Secure Act is you have 10 years to spend all of your money out of your IRAs and pay a whopping tax. And I'm going to go on our YouTube, and you could search for youtube.com, Josh Jalinski, the financial quarterback. And essentially, I'm going to talk about erosion within a qualified savings plan. And there's something called retirement plan erosion. And we'll get really into that. There's also an amazing calculator that I'll show our listeners called Person A and Person B, where you can actually go through your plan and see what a 10-year spend down on your IRA would do. So give us a call now, 800-321-0710. I hope I answered your question. Do you have any other follow-ups to that, Dan?
Well, what I heard, what I read was that it's like they're changing it to 73, and then later on it goes to 75. But it's all very fuzzy, and I was hoping maybe you can kind of decipher it. As I said, I have no idea what would be here if they changing it for 73. And right now are required to go to have the RMD because I'm 72 for this year. I don't know how the whole thing works. It's very confusing.
It is very confusing, and that's why you need the financial quarterback to help you. Call us at 888-988-JOSH. I'd love to meet with you and help you for free. Get a plan together. Now, if you turn 72 this year, my tip would be call us. But number two, maybe you can make sure that you take your RMD by December 31st of this year. So you don't really want to do the RMD until we get greater clarity around the law change. There may be a law change, but there may not be. We really don't know. So I would not take your RMD until December of this year. That way we know. But realize that if you miss an RMD, there's a 50% penalty. That's why you do not want to do it alone in retirement. So essentially, the Secure Act forced you to spend down your money over a 10-year incremental period of time. And when we return from the show, I'll talk more about that. But first, call me right now, 888-988-JOSH, for the 45-minute Ultimate Wealth Blueprint. We'll be live on WOR after these messages. Call me right now. I'd love to meet with you. 888-988-JOSH. We'll be back after these messages. Hi, everybody. This is Josh Jalinski here, inviting you to call my office right now at 888-988-5674.
You want to switch over?
888-988-JOSH for your very own protection, savings, and growth review. You can control what you do with your portfolio in these uncertain times. Asset location, asset allocation, tax strategies, protection strategies, savings
You guys
strategies,
have this, it's
growth
blocking
strategies,
the
and more. So
visual.
give my office a call, 888-988-JOSH.
This is not even on.
888-988-5674. 888-988-JOSH. Call us today. 888-988-JOSH for your free protection,
Turn the
savings,
volume down
and
on
growth
what?
review. That is a one-page, beautifully aligned financial blueprint for your wealth.
No,
You
it
get
was
to
the
see all
caller.
of your assets on one easy-to-understand
this
page.
blocks the
That is the
visual.
protection, savings, and growth blueprint. Call us now, 888-988-JOSH.
Are you
Yes, it
worried
is.
about the recent coronavirus crisis and how it may
I
have
cannot
affected
see
your
the
money?
screen.
Hi, everybody.
We're not
I'm Josh
connected
Jalinski, the
on
financial quarterback, inviting you
Zoom.
to join me for my
People need to
complimentary
do this
6
before a
ways
show
to keep
starts.
calm during turbulent markets webinar. If you schedule and keep
Yeah, you
your
guys need to log
no-obligation
me in
webinar
before a show
today
is
at
live.
888-988-JOSH. It's a great thing to do if
It's
you're
like, give
stuck
me a
at
break.
home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH. 888-988-5674.
You guys can
and
go
go
on
to
my
my
computer
website,
and do that before a show
retirementrealitycheck.com
starts.
today, and take your free investment profile
You
quiz.
should just
and
share
when
it
you buy my
before
book,
you do it.
Stand by.
free gifts. 888-988-JOSH.
Call Josh Jalinski, host of the popular Financial Quarterback radio program, 888-988-JOSH.
We're back. This is Josh Jalinski, the financial quarterback, taking your calls on 800-321-0710. If you have a question on stocks, bonds, annuities, mutual funds, we're talking about how Americans are changing their behavior to combat inflation. And we're here live taking your calls on all matters financial. This is Josh Jalinski, the financial quarterback. If you have a question, now is the time to chime in. We're here for you. Give us a call now. 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, none is a dumb one except the one that you do not ask. So give me a call now. We'd love to hear from you. If you have a question, chime in. We're here for you. 800-321-0710. We're talking about how Americans are changing their ways to combat inflation. There's also been an uptick in people looking for professional advice. In the latest survey, 55% said their bankers were crucial to helping them meet their financial goals, an increase of 5 percentage points from the previous quarter, and 52% said the same of their financial advisors, a jump of 6 percentage points. So it appears that more people are seeking financial advice due to help combat inflation. Death and taxes are two certainties in life, as the saying goes, but many people may not realize that Social Security benefits they receive from the government are also subject to taxes. If your income is below certain thresholds, your benefits are generally not subject to taxation. A recent Mass Mutual quiz found that just 42% of 1,500 respondents near retirement were able to correctly identify whether the following statement is true. It's actually, Social Security retirement benefits are subject to income tax, just like withdrawals from a traditional IRA. So 42% of you are able to identify whether that statement is true or false. Means the other 58% don't know the answer. Social Security is taxed uniquely. It has its own tax law. In fact, Social Security benefits and IRA withdrawals are not treated the same under tax rules. There is no cap on the income you must report from an IRA, but there is a cap for Social Security benefits. It's not well understood, said Nancy Altman, president of Social Security Works, a social welfare organization. The fact that levies are applied to benefits is extremely unpopular. People hate it. But she says it makes good policy sense. I do not, because when Social Security was created by FDR or by his administration, they promised Americans that it would not be taxed. And they broke that promise in the 80s and 90s. And now up to 85%, yes, 85% of your Social Security benefit is taxed now. It's kind of crummy. So, folks, give us a call right now, 800-321-0710. That's 800-321-0710. We're talking all matters financial. When the program was created in 1935, benefits were not taxed. That began to change in 1983 when Congress changed the rules so that up to 50% of Social Security benefits could be included in taxable income if a taxpayer's income was over certain thresholds. More changes came in 1993. So Reagan allowed that one to happen. Clinton allowed this to happen. In 1993, it raised the portion of certain Social Security benefits subject to taxation to 85%. That change applied to higher income beneficiaries. Anybody know what the higher income beneficiary threshold is for taxation on Social Security? Anybody want to comment on that? Call us 800-321-0710. I'm going to open that up for financial quarterback trivia. What is the income threshold to make sure your Social Security benefits are taxed up to 85%? So a lot of people don't realize this. So if you make over a certain amount, you get to pay 50% of your benefits as taxable. If you make over this amount, up to 85%. So if you want to type it in the chat box, whether we're on YouTube, Clubhouse, or live on WOR, call us. 800-321-0710 if you want to get on live with me with your financial questions. Also call us at 888-988-JOSH, where I'd love to shake your hand, get to meet you, and get to help you minimize taxes in retirement. So what is one way to combat inflation? Understand the rules on taxation. The taxation of Social Security benefits. there are things that are Social Security tax friendly. First, the taxes are based on what is known as provisional or combined income. That includes half of your Social Security benefits, plus your AGI or adjusted gross income, and non-taxable interest. This means that any income from wages, interests, dividend off of stocks, or other taxable income, even municipal bond income, counts against your Social Security taxation. Then the 50% threshold or 85% threshold is applied. So I'm going to leave this question unanswered for about 3 minutes to allow you to call us at 800-321-0710 with the answer. Individuals who make up to this amount will pay income tax on 50% of their benefit. Individuals with combined income of more than this pay tax on up to 85% of their benefits. Those thresholds are not indexed for inflation, which means they've not been updated since they were established in the 80s. That's why when the government says we're only going to tax the rich, with inflation, you're going to be rich someday, according to the government. You're going to be taxed more and more. Just think about property taxes. Think about Social Security taxes. There was a time where Social Security benefits weren't taxed. Consequently, over time, more and more people have become subject to taxes on their benefits. There was the intent that it would only affect high-income earners when it was first passed in 1983. But over time, it's reached further and further down into the middle class, said Joe Elsasser, founder and president of Covism, a provider of Social Security claiming software. The revenue from the taxes goes directly back into the Social Security trust funds. So give us a call, 800-321-0710, with any and all financial questions. Next up, we have Gordon. Go ahead, Gordon. You're on.
Yes, Judge. Just a comment on your last. Comment. I guess if the government is going to tax your Social Security benefit that much and not index it for inflation, there's nothing they won't tax. My question is, I know from listening to you on previous shows that you do not like immediate annuities in general as an investment. But I wonder, are there people, perhaps a substantial number of people, who would find an immediate annuity to be a good investment, at least at some time in their investment life? And could you describe the situation that would be good for these people? What situation would they be in order to make an immediate annuity a good investment for them?
Well, an immediate annuity is not something I even like because typically when you die, the money goes to the insurance company. Now, to be fair, you can structure an immediate annuity to go to your heirs with an option called a life period certain annuity or a life with a cash refund. So let's say you put in $500,000 into an immediate annuity yielding 6% a year. So you get $30,000 a year for as long as you live. Pretty good deal if you live a long time. If you die early, $500,000 less what you received goes to your heirs. So that's what a life with cash refund option is. So I prefer an income rider if you're going to do annuities on a fixed annuity or fixed indexed, because your heirs will get your money plus whatever interest accrued while your money was tied up. In an immediate annuity with a cash refund, your heirs get your money less withdrawals plus zero interest. In a fixed indexed annuity with a rider or fixed annuity with a rider, your heirs get your money plus interest, less withdrawals. So the death benefit is generally greater. Now you ask, well, who would an immediate annuity be best for? Somebody who doesn't care what their heirs gets and wants the maximum income possible. But Then the other nice thing about an immediate annuity is there is no internal fee. Sometimes people say, oh, annuities have high fees. Well, immediate annuities have zero internal fees. The fee is, in essence, the time commitment that you're making with the annuity. Now, some people say immediate annuities are irrevocable. There are irrevocable immediate annuities, but there are also ones where you can get all your money out in 10 years with something called a commutation value. So I hope that helps you, Gordon. Any other questions?
No, not at this time, Josh. Thank you very much.
And a lot of you are concerned about the market and looking into annuities or hearing from your financial advisor that an annuity may be right for you. We have an annuity shopping service where we will compare annuities to stocks, bonds, mutual funds, index funds, ETFs. So you get to see what's right for you, not what's right for your particular salesman. We also shop every annuity in the given class for you so you know you're getting the best bang for your buck. Okay, Gordon? So give us a call, 888-988-JOSH if you're shopping annuities. Next up, Barry has a comment on how he's cut back. Go ahead, Barry.
Good morning. Cooking at home and going to food pantries.
Oh, great. So when you go to a food pantry, do you have to provide them like statement of income that you're struggling or no?
Yes.
Yeah. Well, well, that's good that you're going to a food pantry. Our church's pantry has a ton of stuff. So a lot of donations. They get so many donations, they give stuff away often. So.
And I have an answer to the trivia question also.
Go ahead.
$25,000 for single and $32,000 for married.
Bing, bing, bing. At 20, well, I have 25 and 34, but we're very close. Individuals with combined income between 25 and 34, yes, single taxpayers will pay income tax on up to 50% of their benefits. And then if you have a couple who makes over 32 but under 44, they will pay 50%. So the threshold is between 32 and 44 if you're married, 25 and 34 if you're single. And if you make over 34 grand, you're single, you're considered rich for the government. So 85% of your Social Security is taxed. And if you're married, if you make over 44 grand a year, you may pay tax on up to 85% of your benefit. So there is a way to lower that. You basically put money in things that do not credit you tax as earned. So anything that gives you a 1099 interest form, you don't want. So that's where you could put money in tax favored accounts, and actually you could potentially get below that threshold because 50% of your Social Security income doesn't count. So you could have a pension, let's say, of 30 grand a year, Social Security of 24 grand a year, 12 plus 30 is 42. So you'd be under the threshold for 85%. So only 50% of your Social Security would be taxed. It's very easy to get above that. So there are strategies to get below that. We could help you at 888-988-JOSH. I'll be talking more about Social Security and what you can do with your money in these uncertain times. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jalinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're going to the phone lines at 800 321 0710. And then we have Dan. Go ahead. You're on with Josh Jalinski, the financial quarterback.
Yes, your real estate expert before said he felt there might be a slight cooling in the real estate market due to the interest rates going up. I've been looking to maybe get a beach property, Delaware, New Jersey. I live in New Jersey. For the last couple of years, I look at the prices pre-COVID. You've got 30-40% appreciation on these properties. It just seems like it's ridiculous. So what is your take on the real estate, at least the beach areas, whether it's Delaware or New Jersey? I live in New Jersey. It just seems I'm waiting for like a downturn, and I'm not seeing it.
Well, like I said, I do not necessarily agree with his perspective. I believe it takes, for those of you just joining us, we had Barry Habib on last hour. Excellent podcast that will be available within the coming days. So hit subscribe on Spotify and Apple Podcasts. Search for The Financial Quarterback. I would wait. I think you got 3 to 5 years before you see a low in Jersey Shore or Delaware real estate. By the way, I prefer Jersey beaches over Delaware. You ever go to Delaware? It's the sand is not the same. No offense. I have some great clients who live in Delaware.
Well,
I like the Jersey Shore sand. It's beautiful. Delaware, you got to drive all that way, or you got to take the ferry. Give me Cape May, Ocean City, LBI any day over Rehoboth and Lewis. And, I love Delaware, don't get me wrong. But comparatively, I prefer Jersey Shore over Delaware beaches any day of the week. However, probably offending all of our Delaware listeners. But here's what I would do. I'm not giving you investment advice or real estate advice, but I'm going to show my screen. Let's go to the screen. I'm going to, on the YouTube, and you want to make sure you subscribe to the YouTube. Okay, Dan? I have the Case-Shiller index up. So if you look at the chart, the top of the real estate market was 2006. And there's a lot of, scammers pushing real estate right now. Now, mind you, if you look at the top in real estate the last time, it lasted from 05 all the way to 07. I think the top now might take 12 to 18 months to burn off excess inventory. Because Jim's kids, they might want to buy a house. Your kids buying a house yet, or are they waiting? They're waiting. So I believe you give it 5 years and you'll get great deals on your properties. That's just me. I think COVID caused beach houses to inflate dramatically, like 40%. I think they will see a 20% cooling within the next 12 to 18 months, and we may see a 40% correction from now to 5 years. But realize that it takes a while. It takes a while to see real estate go down. You know what I mean? So make sure you're smart. Does that make sense to you?
The other thing is, you're a financial guy. The economics of a Delaware beach property versus a New Jersey property, the taxes are dirt cheap in Delaware versus New Jersey.
Yeah, but I'd rather rent a beach house in New Jersey. I mean, think about it. You get 4 weeks of the year where really you're going to go on vacation, unless you're going to go on vacation for all 10 weeks of the summer, because you got to work. So
right. Well, I'm in my mid-60s. In a few years, I may not be working, so that's why I'd have a little more time.
If you prefer Delaware, that's fine. But I think Delaware is blown up too. So.
No, I just look at $1,000 tax a year versus $10,000 tax a year on a property. So that's the economic question there.
Oh, well, obviously the economics, 1,000 is less than 10,000. I'm just talking enjoyment.
Right. Okay. So yeah, I also look at you're looking at the economic and the enjoyment end of it. So
some people want to just be near the beach, right? So they don't care whether they're Delaware, North Carolina, California, wherever you go. They just want to be on a beach. Some people prefer nice waves, nice sand. That's all. I like Jersey beaches.
I just thought you had a little better economic situation with the with Delaware, where you're not paying exorbitant taxes on the property for eternity.
Oh, you're right there.
And if you're retired or you're retired and you pay the property off in Delaware, you're not too bad. But in New Jersey, you're perpetually paying the high taxes on situations, and I'm talking for a secondary property.
Well, it sounds like Delaware is right for you then.
Yeah, I get what you're saying. Okay, your guys will be in touch with me. I'm probably going to
I have clients who have housed beautiful homes in Bethany Beach, and those are nice places. But they also bought them years ago when you could buy. I mean, back in the day, you could buy like $1 million. You were on the beach in Delaware. That was different. So a same house that might be $2.5 million was $1 million. Now the houses are $2.5 to $3 million, or $5 million or more. It's insane. It's just, I don't know. That's the other thing too. It gets to a point where if you're buying a beach house and you could rent for a certain price, like just rent for a couple weeks or rent for 4 weeks, or but that's just me. If I was looking at buying beachfront real estate, which I'm looking to, so I get it, I would wait 5 years. I'd wait 4 years. I'd wait 3 years. Don't never buy real estate at the top. It's a dumb move because it's illiquid. So next up, we're taking your calls at 800-321-0710. If you have a question on stocks, bonds, we have another Dan. Go ahead, Dan.
Hello, Josh. I have a question. I'm 70 years old. I have end-stage Parkinson's, and I have a mutual fund that has roughly $53,000 in it as of a couple of days ago. I don't know what happened with the market since then. It could have hit it again, but I was just wondering what you suggest I should do with this. Should I pull it all out now to have some cash, or wait until this thing goes by, which I might not be here for, and try to keep it and get some of the money I lost in the last couple of months back? I mean, I've taken like a $7,000 hit on it since Biden took office.
Do you need more or less? Like, do you need the money or do you have time?
Well, the time is the one thing I don't have.
No, but this is a very important, and I'm sorry for what you're going through. I get this question a lot from people who have a physical malady or their health's bad, and my prayers go out to you.
Right.
They think because their health expectancy might be less, that changes their time horizon. And you may not have as long of a time horizon due to a health concern. But what I'm saying is, are you going to need the money or no? Is this for your heirs?
Pretty much without it. I just use it, here and there for we need something, like if my lawnmower blew up the other day, so I need a new lawnmower. That's $2,000.
Do you have an emergency fund of 6 months in the bank, cash?
6 months in the bank, cash? Just about, yeah, with the money I have.
Okay, so I would make sure, number one, you have an emergency fund for those, but maybe you raise cash. Maybe instead of 6 months, you have a year's worth of living expenses. Okay. Maybe you have 2 years. So maybe you don't get out of the market completely, but maybe you have enough hedged. Maybe you have 1 to 3 years in a volatility buffer. That way you could weather a financial storm. But I want to make a distinction between health time horizon and money time horizon. If the doc says, okay, you're not going to live as long, and I'll pray you do live longer. Let's say you live till 90 and you're 70, you could live another 20 years, right? And you might live another 4 years. You don't know. I mean, my parents died in the early 70s, so I get your concern. But if you don't have as long of a time horizon, right? Maybe your kids do have a long time horizon. So they could wait out the storms of the stock market. So I think the answer for you, and I'm not giving advice, I would call me at right now at 888-988-JOSH. We have operators standing by live to schedule an no obligation review, but I would make sure you increase your volatility buffer to one, if you have 6 months of emergency fund, have a year. Because if you can weather a year, and you might say, I don't even have a year, I don't know. Well, that's why I say have a year, because then at least your year's expenses are covered. If you want to go to Alaska on a cruise, take that money out of the market. Because you got to realize if we're in a bear market, the last true bear markets lasted from 2000 to 2002 and 2007 to 2009. The COVID bear market was very quick, but generally speaking, they last longer than people think. So I talk about this in my book, Retirement Reality Check, to get a 1 to 3 year volatility buffer so that you don't feel the pressure to sell because, you might have health issues, you might be, older, whatever it is. Make sure you have a volatility buffer and call me at 888-988-JOSH. I'd love to help you with what you're going through. Does that make sense, Dan?
Yes, it does. Thank you very much. One thing, you guys calling me, so is that the same as me calling you? I gave them my number.
Yeah, they can call you, but, we'd love to hear from you. 888-988-JOSH, okay? You
got it. Thank you very much, Mr.
Take care, Dan. Thanks so much, folks. We're going to go to the phone lines after this with your questions at 800-321-0710. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jalinski.
Josh Jalinski is your guy?
Listen, if you're 10 years or less from retirement,
which I am,
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jalinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Protect your portfolio from the dreaded MITE, the massive income tax acceleration bill, otherwise known as the Secure Act, killed the Stretch IRA. What does that mean for you? Your heirs are going to have to pay more taxes on your IRAs. Are you prepared? If you have a 401k, 457, 403b, or IRA, you have to do a tax analysis on your IRA and make sure you are protected from the dreaded income tax acceleration bill known as the Secure Act. Call my office right now at 888-988-JOSH. 888-988-5674. The Secure Act increased the age of RMDs from 70 and a half to 72, but many people are unaware of the death of the Stretch IRA. So call us now, 888-988-JOSH, 888-988-5674. Okay, we're back taking your calls on All Matters Financial. You're going to want to flip over to YouTube for this one. We are live on YouTube. And I'm going to show you what this new 10-year spend down on the Secure Act would do. We're going to share my screen. Okay, so share the screen. It's tough to see, I guess. Okay. So let's say you have $1 million in a 401k, the prototypical $1 million account. Let's say you make 4% interest, and let's say you have a qualified plan. And your heirs tax rate is 35%, let's say 20-something% federal, another 8 to 10 state, and you have a 3% inflation rate. I'm going to show 0 on the inflation rate just to show you how this works. So let's say your heirs inherit it when they're 65. So you die at 85 or 90, your kids are 65, and they have 10 years to spend it down. Okay, the way this works, go to person B on the chart, And this is powerful. What I'm explaining now is how they've changed the rules on IRAs without anybody noticing. And I'm going to do a pay down to illustrate. And the way this calculation goes is we can actually model out what the 10 years spend down would do. So it's a pretty powerful concept. But the problem is if you have an IRA or 401k, the entire rules have changed. And we have this very powerful calculator called Person A, Person B, where most people think like Person A, which is an interest-only paradigm, meaning, oh, my heirs are going to live off the interest when I die. Well, fat chance it can't happen again. The stretch is killed. Ding dong, the stretch is dead. You know, like the witch is dead. So the way this works, and I'll show this how this works, is when you have this calculation tool. So the way this works is you in your mind think you can leave $1 million to your heirs. They can live on 40 grand a year and they'll never spend the $1 million. Right? Wouldn't that be the dream, Jim? You have $1 million, your kids get 40 grand every year to think about Jim. And that'd be cool. That's really what you can do that, by the way, in a trust. You can do that with life insurance. You can do that with stocks owned outside of an IRA, but you can no longer do this with an IRA. It's called the stretch, and the stretch is dead. Unless you have a special needs child, unless you have children who are 18 and under. I was trying to have, an attorney was telling me, my attorney, I love the guy. He was telling me, put it in a trust, your IRA money. And I said, no, because I know the law. I know the new law better than the attorneys. So if your kid's 18, now why do they do that? So they can get those trust fees. You know, I went, it's interesting. I asked an attorney, I said, who are you going to use as trust company? They said, oh, this is a trust company that I trust. You want to use the right trust company. I went and looked at the fine print. The fee was 2% of the estate a year, or for as long as they administer it. Then I went and we shopped, and I told one of our wonderful staff members, Jim, Joanne, one of you fine people, I said, go check out what the trust fees would be at so-and-so company, companies we deal with. They were like 0.4, 0.2, 0.5%, very low in regards, and they would administer the trust. So a lot of people get screwed because they trust these trust companies, and you got to be careful. So Person A is showing the old paradigm of interest only. You have $1 million, you earn 4% in interest, you have 40 grand. Does that make sense, Jim? Then Person B is showing what's called a spend down. So I'm going to do a quick edit. Your heirs, if they inherit it, will have from 65 to 75. I'm assuming when you die, your kids are 65. Could be younger, they could be older. Then they have to spend that money over 10 years. So they have to take 114 grand out, pay, I put zero tax on there now to show that if you had a Roth, all of that money, if you left them $1 million, would grow and they would have received over 1.255 tax-free. That's the benefit of a Roth or life insurance, by the way. But we don't live in a tax-free world, so I'm going to add the taxes. We could say, I don't know, let's say it's a 30% tax for your kids. So whatever the kids' tax rate is. So if your kids have done well, oh, my kids have done well, they've gone to Harvard, and they've done so well. Well, your kids are going to pay much more in tax in this, but let's assume it's 30%, state and federal. They got to pay all this tax on the money. Boom. Made a little mistake on here. I put non-qualified. Let's go to qualified. Let's look at the results. And boom, 1.255 million goes to 878. The government gets an extra 376,000 because you didn't plan. This is the new law. This is why it matters. You can watch the YouTube and click rewind if you don't understand what I'm talking about. I'll break it down when we return. I got to take the final break of the hour. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement.
Family, Romans,
you may already have a
countrymen.
plan, but is it
If you
the
have a
right
question,
one?
type it in the
Josh
chat. I'll bring you
Jalinski,
up.
host of the popular Financial
On this
Quarterback
matter
radio
of
program,
the
is
death
ready to guide you
of the
towards financial
stretch.
freedom. He challenges the ways your parents and grandparents saved money with fresh
We have a whole
strategies,
calculator
which are exactly what
that
you
will
need
go
to
into
navigate
how you
today's
can
volatile
mimic a
economic
stretch.
climate. Josh's new book,
The
Retirement
IRA
Reality
will
Check,
essentially
is
be a
available to
10-year
order on
trust
Amazon. It's an easy
for your
read
kids
that guides you through his system
if
for
done
securing
right.
your financial freedom, including
If
tax
done
saving strategies,
wrongly,
understanding the right investment mix, and more.
there will be
Order
a
now.
massive
Retirement
income
Reality
tax
Check. Call Josh at
acceleration.
888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're back. This is Josh Jalinski. Let's go back to my dreaded board of horrors, the Dell. By the way, I'm using a touchpad screen, but I have to use my mouse and keyboard to work it. So it's now Tom is smart, so he'll say, oh, it's because the software doesn't take draw on it. And he's probably right. But, you know, it's just a funny thing that I can't use my pen on the drawing stylus. So anyway, so let me break this down for you. Let's change this. Let's say you die at 75, like this guy who called, was worried about Parkinson's, and his kids are 55 when he passes. So they have to spend all the money by the time he's 65. And let's say instead of having $1 million, you have, I don't know, 500,000 more normal people problems. Because you have 500 grand in an IRA that you didn't spend. They have to spend 57 grand. So if you leave 500 grand, assuming a 4% rate of return, that 500 grand, this is also why it's important if you are near death or in retirement, not to just give up on growth, because you can still make money in a diversified portfolio over a 10-year period of time. A lot of people think they get older, I'm going to put all my money in cash. You can actually make some interest on your money. So let's assume 4%. Right now you can get 3% on fixed rates at certain products. So 4% isn't too far-fetched over a 10-year period. So if you have 500 grand and you spend 57 grand a year out of that, you pay tax on 22 grand. So on a 500 grand account, 216 grand of that will go to the IRS. That's assuming your kids are in a low tax bracket. But let's assume they've done really well and they pay 50% state and federal tax. Boom, 342 grand goes to the government on a 500 grand account. Now that part of that's because there's some growth. So the gross withdrawals were 627K. The annual tax added up was 342K. Legacy value after tax is zero. So all that money's gone. This is the new rule. And this was signed under President Donald J. Trump, a Republican, who did not seek consultation from me, because I would have told him this is a horrible tax law that hurts middle-class wealth. But alas, both parties colluded against the American people to hurt us. So give us a call, 888-988-JOSH. I would love to shake your hand. Give you a copy of my book, Retirement Reality Check. If you schedule and keep your no obligation review, 888-988-JOSH. Call me today, 888-988-JOSH, and you'll get a free book when you schedule and keep your no obligation review. 888-988-JOSH. We talked about a lot on this hour's show. Secure Act, the 10-year IRA spend down. We talked even a little immediate annuities and Social Security taxation. So it was an action-packed hour. Stay tuned. I'll be doing more YouTube Live and Clubhouse Live when we return. This is Josh Jalinski, the financial quarterback. Call me right now, 888-988-JOSH, for their free review if you're worried about your money in these
The
uncertain
preceding
times.
program was sponsored by the Jalinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities, or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective
Josh,
of current
just unmute.
positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Investment advisory services offered through Wealth Quarterback LLC.
WOR and